You're 18 years old. You finally decide to invest your first bit of money into the stock market, and for a while, everything feels amazing. Your investments climb higher every month. You feel smart, confident, like you've cracked some secret code everyone else missed. Then suddenly, the market crashes, news anchors are panicking, experts are predicting disaster. People around you start saying things like, "Get out before you lose everything," but instead of selling, you stay invested. Months later, the market recovers. Then another crash happens, and another. The dot-com bubble bursts. The financial crisis wipes out trillions. A global pandemic shuts down the world economy. Every single time, fear takes over. And every single time, investors start asking the same question. Is this the end? But here's what's fascinating. Despite all the crashes, despite all the panic, despite all the terrible headlines, the market kept moving upward over the long term, and the people who stayed patient were rewarded the most. Now let me show you something crazy. If someone had invested just $250 every month consistently for decades into a broad stock market index fund, not chasing meme stocks, not gambling, not trying to get rich overnight, just investing steadily, they could end up with over $1 million. That's the real power of investing. Not luck, not timing, not hype, consistency. And honestly, most people never experience this because they overcomplicate everything. So, in this video, I'm going to break down exactly how beginners can start investing using nothing but their phone, no confusing Wall Street jargon, no fake guru nonsense, just the basics that actually matter. Now, before we start, this is important. I'm not a financial advisor. This is simply the strategy that has worked for me personally. And before investing a single dollar, make sure you have an emergency fund saved first. At least 3 to 6 months of living expenses. Because investing works best when you're not constantly forced to withdraw money during emergencies. All right, step 1. Open an investment account. This is where most beginners freeze up because there are so many apps, brokers, and account types out there. But honestly, it's much simpler than it looks. Today, you can open an account in minutes directly from your phone. Years ago, investors literally had to call stockbrokers over the phone just to buy shares. Now, it takes seconds. The most important thing is choosing a tax-advantaged account if one exists in your country. These accounts help you legally reduce taxes on investment gains, which makes a massive difference over decades. After setting up your account, the next step is funding it, and this is where people think they need thousands of dollars to begin. You don't. Some of the most successful investors in history started small. What matters most isn't the amount, it's building the habit. Even investing the cost of a daily coffee consistently can become life-changing over time. Now, here's where most beginners make a huge mistake. They try to pick the next Apple, the next Tesla, the next stock that's going to 10 times. But the reality is, picking individual winning stocks consistently is incredibly difficult. Even professionals struggle to beat the market long term. That's why many experienced investors prefer index funds. And honestly, this concept changed my entire perspective on investing. Think about it like a music playlist. Every year, some songs become massive hits, others disappear completely. The stock market works similarly. Some companies dominate for years, others slowly fade away. An index fund automatically adjusts over time by holding large groups of companies together. So instead of betting everything on one company surviving, You own small pieces of hundreds of businesses at once. That means if one company struggles, your entire portfolio doesn't collapse. For beginners, this is one of the safest and simplest ways to invest long term. And the most powerful part? You can automate everything. This is called dollar cost averaging. Instead of trying to guess the perfect time to invest, you simply invest a fixed amount regularly, every week, every month, every year. Whether the market is up or down, this removes emotion from investing completely. And over long periods of time, consistency tends to outperform panic. Now let's talk about something most people underestimate: time. Time is the secret weapon in investing, because investing isn't just about earning returns on your money. It's about earning returns on your returns. That's compound growth. And once compounding starts accelerating, the numbers become ridiculous. Someone who starts investing at 20 can end up dramatically wealthier than someone who waits until 35. Even if the older person invests more money later. That's why starting early matters so much. Not because you need to be rich, but because time does the heavy lifting for you. Now, eventually, some people will want to try investing in individual companies. And if you do, don't treat it like gambling. Don't buy stocks just because social media is hyping them up. Instead, focus on understanding actual businesses. Ask questions like, does this company make money? Is revenue growing? Does the brand have long-term potential? Is leadership competent? Because when you buy a stock, you're buying ownership in a real business, not a lottery ticket. Personally, I prefer long-term investing over short-term trading. I'm not interested in staring at charts all day, trying to predict hourly price movements. I'd rather own strong businesses for years and let time work for me. And yes, markets will crash again. That's guaranteed. There will always be recessions, fear, panic, bad headlines. But history has shown something very important. The investors who survive those storms are usually the ones who build the most wealth. Not because they're geniuses, but because they stayed consistent while everyone else reacted emotionally. So if you're young and thinking about investing, don't wait for the perfect moment. Most people spend years overthinking while time quietly passes them by. Start small, stay consistent, think long term. Because building wealth is usually less about making one brilliant decision and more about repeating simple decisions for a very long time. And trust me, that's where things start getting interesting.